ABR is down over 30% and still pays a massive 13% dividend. Bargain opportunity or dividend trap? Let's break this down in 3 minutes. Hey everyone, welcome back. Today we're taking a look at Arbor Realty Trust, ticker ABR, a high-yield REIT that's been getting a lot of attention lately. If you're in your 20s or 30s and trying to build wealth through investing, this is a name you've probably seen around. So let's talk about what's happening with ABR, why the stock dropped so much, and whether the fundamentals still make sense right now. Arbor Realty Trust isn't your typical real estate REIT. Instead of owning apartment buildings, they finance them through bridge loans, mezzanine loans, and multifamily mortgages. That business model makes them very sensitive to interest rates and credit cycles. Over the past year, ABR's stock price has fallen more than 30 to 40% from its highs, now trading around $8 to $9. That kind of drop is basically the market saying it's worried about real estate credit risk, high interest rates, and whether borrowers will keep paying their loans. So let's break down the fundamentals. ABR's book value per share is about $12.08. At today's price, that means the stock trades at roughly 0.7 to 0.8 times book value, meaning you're buying it for less than what its assets are worth on paper. On top of that, ABR pays around $1.20 per year in dividends, which gives you an extremely high dividend yield of about 13 to 14%. That's a huge yield for any REIT. And while high yield usually means high risk, it's still very attractive for income-focused investors. Now let's use a classic value investing metric, the Graham number. For ABR, the Graham number is around $14.47. Compared to the current share price near $9, that means ABR is trading at roughly 80% of its Graham valuation. That can signal undervaluation if earnings and book value remain stable. And look, I'll be honest, investing in high-yield REITs sometimes feels like gambling. But the truth is, real value often hides exactly where most people are too scared to look. There are some clear positives here. You get a big dividend. The stock trades below book value, and if credit markets stabilize, there's potential upside. But there are real risks too. ABR is extremely sensitive to interest rates. Its payout ratio is high, which raises questions about dividend sustainability. And if real estate loans start defaulting, the company could take a hit. If you like these short, straight-to-the-point breakdowns, just hit like so I know to make more videos like this. It really helps. So in the end, ABR is a high-risk, high-reward play. It could be a bargain, or it could be a trap depending on how the real estate credit cycle plays out. Always do your own research, stay diversified, and invest smart. Thanks for watching, and I'll see you in the next one. Take care.